Here is Tom Lee today on CNBC, and then we will keep going from there.
The market took a little bit of a move lower on that as well, just given where rates are, concerns about the deficit, et cetera. Your thoughts on all three?
Well, it does seem like a pattern 2025 as markets sort of take a hit on Fridays and maybe panic Monday. So I don't know if that's going to be the case. To me, I think the inflation headlines from UMich they're not great to see, but also I think that they are messed, or there's a political component to this, because if you break that down between Democrats who see 5% inflation and Republicans at zero, the blend is actually pushing this number up. But to me, it just gets messy around elections.
Yeah, but I mean, let's be honest. There are broad concerns about parts of this agenda from this White House, including, I might add, from the Fed, that it could be inflationary when rates are already more elevated than I think the Fed would like to see. They'd like to be able to cut more, but their hands are tied. And one of the reasons their hands are tied because of tariffs and unknowns about inflation. Fair?
That's fair. I'm not sure the UMich survey reflects their assessment necessarily of the tariffs as much as, let's say, the bond market. And the bond market seems less concerned about it because, as you know, yields have backed off from 4.8 towards 4.5. But you're right. Tariffs are a reason to be uncertain. But so far, I think if I looked at how markets reacted, I think they've actually taken them in stride.
I mean, your biggest takeaway thus far, you say, is that the market's proving resilient, which, I mean, let's be honest, too. Since the start of this bull market, it's been one heck of a resilient market. It's been able to deal with almost anything thrown in its face. You've had a couple of panic moments. Monday, off of the tariff news, last August with the unwind of the carry trade, and then we just continue to set new highs.
That's right. And I think in 2025, a lot of investors thought maybe the playbook would change because we just put 20% years behind us. But I think with January being up 2.7%, and I think these sell-offs being bought, it does feel like the same market that we had last year.
What are you worried about?
Now that's a really good point for a second, because, he's correct. Investors felt after two 20% back-to-back years, 2023 and 2024, that we would have some pain in 2025, at least in the beginning, in terms of like, hey, every dip's not going to get bought. But every dip's getting bought. I mean, every single dip is getting bought. And I think the reason for that is because the macro data is strong enough, earnings data is strong enough that there's nowhere else to put your money, right? Maybe some treasuries, maybe money market funds. But because the dip is getting bought, it really does feel a lot like 2024.
Well, I'm worried about sentiment becoming too bullish, but actually but it's turned the other way. Sentiment actually has weakened pretty meaningfully. And I'd worry about a policy error from the Fed. And as you know, the bond market still thinks there's more than a 20% chance the Fed hikes this year. I think it would be obviously a policy error if they raise rates.
What about a policy error from the White House?
That's also something markets worry about, yes. But so far, I would say that the news that we've seen on tariffs, they've had more bark than bite, meaning they've proven to be opportunities for investors to buy.
What would you buy?
Well, the big news this week in our minds is the ISM moved back above 50. That really does point to earnings dispersion improving. So I like industrials, the financials. I mean, the small caps, which have been, not a great outperformer yet, but we still think small caps are going to do well this year.
And what happens if some of the uncertainty around DC and policy has a more negative impact on not only sentiment, but actual transactions? I saw a stat today that M&A is off to an incredibly slow start this year, when part of the narrative coming into this year was animal spirits. Can't tell you how many times I heard that phrase over the last 3, 4, 5 months.
Yeah.
What if we don't get that?
I mean, it's still too early, right? Because we're only 1 month into the year. The recovery and optimism, both in the NFIB and even the ISMs, I do think it would sort of argue CEO confidence should be better. So I would expect M&A.
We had all but one of the mega caps report. We got to wait a couple more weeks for NVIDIA. What's your takeaway?
Well, it's been a good earnings season so far. The Mag 7 as a group hasn't been great. In fact, they've been a drag on the S&P this year. So part of it is it's telling me I think a lot of good news is baked into some of these names, and especially with CapEx going up. But it doesn't mean I don't think they're market performers. I just think the outperformance this year comes from financial, small caps, industrial.
Canaccord Genuity today on the Mag 7. We think it's fair to say this has been the softest quarter for this group collectively in the last few years. Is that a meaningful softness that maybe the best times for a while are behind it?
Well, and that's a relative term, right? Because on an absolute basis, these companies are growing far faster than the S&P. But from a, what's priced into the stocks, clearly it wasn't a market surprise. That's why year to date they haven't been great.
What about you're paying up, in some respects for declining revenue growth, especially in key areas like cloud for some of these players where that's an essential part of why you were willing to pay up in the first place? That matter?
Well, these are secular stories. So to me, stocks might actually underreact to earnings and they might overreact to earnings over time. And, they may consolidate for several years. But to me, the key drivers for why you want to own the Mag 7 haven't changed.
Seems like.
And I think Tom's right about that, right? A lot of these stocks were just trading at extremely, not even high multiples, but just high stock prices relative to the expectations for growth. And that's why we saw Amazon and Google take a little bit of a dip. But overall, still incredible companies. Palantir right here, giving up pretty much all the gains it had today as we get 4 minutes into the close, 111.42. At one point, we did get to 116.30, looking like it might go red into the close. We'll see. It's hovering above green right here. So we got 4 minutes left. Grab's up 2.4. Uber's up 6. Robinhood, it looks like it's going to get a 55.50 close, which would be exceptional for Robinhood, getting above that $55 mark. Cloudflare's up 17%. You got Palantir again, 111. Tesla, 361, down about 3.34. Their Chinese registration numbers did come in a lower 11% year over year. Maybe that's contributing to it. But I think more so it's just people getting a little nervous about holding Tesla without seeing a lot of the results from FSD Robotics yet. SMCI right here up 7.2%. We did get an update from Trump today as well, who spoke with the Japanese prime minister. And in that press conference, he did say that he wants Elon and Doge to look into spending budgets for the Department of Education and Pentagon. He says we're talking about trillions of dollars being wasted. We've already found tremendous corruption. Now, why is this relevant? Even if you don't care about Elon or Trump, it's relevant because the 10-year is paying a lot of attention to what Trump is saying about government spending, and they're paying a lot of attention to what Elon's doing. And one of the arguments for why the 10-year, which is still below 4.5%, this thing was 4.8% back in early January. One of the reasons that the 10-year could come down to the low fours, maybe even below 4 somehow, is if the bond market feels the government is legitimately going to cut billions and billions of dollars of spending, because at that point that would be a hedge against some of the inflation warnings that the 10-year has been selling, or that the 10-year has been selling off on, which has caused bond yields to go higher. So from that perspective, if Trump is serious that they're going to redo how they audit the Pentagon or the Department of Education and maybe cut costs in certain areas, again, we could see the bond market reacting to that, and that could be potentially positive for equity.